I just imagine owning and going through this process with managing over 2,000 rental properties. What are some of the lessons that you've learned through that process that maybe most investors wouldn't know, but probably most realtors wouldn't even know as well? What are some of the realizations you've had at the scale that you have about residential real estate investing?
There's been so many lessons learned with 2000 doors under management. I'll be very honest. Uh, One thing from an investor standpoint that we have seen, again, I've been doing this for almost 15 years. And one thing that is kind of a myth a lot of investors see is how sexy real estate is, how it's the get rich quick scheme that a lot of your gurus try to push, and that is not the case. Now, we have seen this work time and time again over the years. We have seen investors who purchased with us very early on, purchasing properties in 2014, 15, 16. So all those people are like, yeah, it's probably not a good time to buy. I'm going to wait until a little bit longer, a little bit longer. Those investors that purchased with us early on have seen the rewards. Now, if they've chosen to sell their properties, some of them have doubled their equity. And so that, I think that just further proves that never waiting to buy, you buy and wait. That's kind of the goal with rental properties, and getting in when you can. We've seen that time and time. It is not a get rich quick. If the goal is for you to, like, I want to buy 5 properties and quit my job tomorrow, I would strongly not recommend that. I think that real estate is a great vehicle to get you to retire early, but it needs to be coupled with strategic planning, and making sure that you're set up for success, with all of your cash flow, and planning for those risks. I think from the property management standpoint, the biggest struggle or the biggest lessons we've seen compared to other real estate investors, I would probably say the concern with fair housing. We've seen
Mm.
over the last year, there's been a lot of property management companies that have been allowing investors to pick and choose tenants. And so we've had investors come to us and say, well, I would like to choose my tenant. I just had an eviction and I really want to say. And I think that's been a very big lesson that we've learned in saying, I'm sorry, Mr. Investor or Mrs. Investor, you're not allowed to do that. That's I think the first fine if they find out, or if there's a complaint. I think it's about a $33,000 fine, initial fine, and
Oh my
potential
gosh.
suspension of your real estate license. Yeah, so it's extremely serious, and so that's been a pretty big lesson that we've had to work through. That maybe I don't necessarily know that if you're active in real estate investing, or if you are a real estate agent, that you necessarily see that day in and day out. And we do, especially when processing as many applications as we are from the single family side of it. See, did that answer your question? That was a
That's
little
a
bit of
that's
both from the property management and the investor side, but
it's a great tip. Great tip, Lindsay. Yeah, I mean, you as a landlord, you have to have a set of qualification standards. I want a credit history that looks like X. I want income that is a certain multiple of the rent, or a percentage of the rent. You've got to have a set of standards, and then if somebody meets those standards, you can't say, well, I'm not going to let you in because I don't like your last name, or I'm going to wait for somebody else. You have to have a set of standards. And if somebody applies, you have to give equal opportunity to those properties. And I didn't
mhm,
realize the fine was that big, Lindsay.
it is.
But in our management, my mom, eventually after being a serial entrepreneur and lots of businesses, went on to found a legal career, and she started Utah Law Lady, and she was an eviction attorney, believe it or not, for 20 years. And so she's helped us run our management company, and of course she's very good at helping us make sure we don't violate fair housing. But you've got to watch that. You
You
need to
have
make sure
to.
you have a management company that's watching it, or you have to watch it. There's no margin for error there.
Yeah, and I think that the number and the way and our size has allowed us to learn those lessons very early on and adjust and make sure that we have policies in place to keep. And so, if we were to get fined, yes, that would come to the property management company, but that would also negatively impact the owner. So, yes, please
Yeah.
partner with property management companies that have been in the business that know the fair housing regulations and know kind of really what their state, what their local law requires them to do, because you could definitely get caught up in that.
Yeah, great call. I love that.
This is the easiest way for self-employed business owners to qualify for a home loan without the headache. If you're a business owner or self-employed, you understand that sometimes banks just don't understand our complicated income structures and can make it a real headache to qualify for mortgage financing. But there's a better way. We specialize in home loans specifically for entrepreneurs, using your real income, not your after-tax deductible income, enabling you to qualify for a home loan much faster than traditional banks. If you're dreaming of buying a home, don't let traditional underwriting guidelines hold you back. When banks say no, NEO says yes. Click on the link in the description below to schedule your complimentary consultation now.
Okay, so our audience is mostly self-employed entrepreneurs and medical professionals, and both of those different professionals want to replace active income with passive income. So let's just talk about, like, what is a realistic entry point in terms of capital, timeline, expectations? Like, what does a typical deal look like for somebody that is looking to replace their active income with passive income?
Your typical deal. So you're basically your point of entry for purchasing one of our properties. And again, this is whatever your goal is. So if your goal is like, hey, I want to, I'll give you an example, mine and my husband's personal portfolio. We practice what we preach, and we are acquiring properties every year. Our goal is to purchase 2 properties every year while we pay off 1 each year. So that's kind of the path that we're going. And within 10 years, we've kind of mapped out where we want to be comfortably and have said, okay, in 10 years, so when I'm 50, I'm going to be able to, not that I'm going to necessarily walk away from Spartan, but I would be able to. I would have everything being able to be paid for by my rental portfolio and live very comfortably. So it really, I think, depends on what your goal is on timeline. But your point of entry for our properties, our average purchase price is $165,000. So it's extremely affordable. Our first year rate of return, you're going to see anywhere from a 9 to a 10.5% on average. Now, with that comes our forward commitment. So we buy down upfront your interest rates. Interest rates have been a very big factor over the last few years, and we've seen a lot of investors kind of recoil. So we have partnered with lenders that allow us to buy in bulk down to a 5.5% interest rate. So that is what you're able to secure. That is not an ARM. That's not a balloon. That's a 30-year conventional loan that you can secure and purchase the property. So you're only looking at about 20% down for that first property to lock in a 5.5. Also, please always have reserve. Again, we're doing renovations up front. We offer other warranties. We offer a 90-day maintenance warranty. We offer a 1-year lease warranty. So if your property goes into eviction for whatever reason in the first 6 months of ownership, we're going to start paying your rent for you. So while we have those protections in place, hey, life happens. And so you want to have that reserve. So you want to put back some of that money and then use that 20% to have that initial purchase. Now, again, it depends on how many you buy moving forward, what your overall goal for your portfolio looks like. So I think that can vary by individual investor.
Totally. So I love the idea on the forward commitment. So you're taking out a forward commitment, just like a home builder would take out a forward commitment, and doing that through direct investors that enable you to buy down the interest rate of the loan for the buyer who's going to buy that
Correct.
property from you over the life of the loan, over 30 or 15 years, not a temporary buy down. Is that correct?
Correct. It is a permanent 30-year buy down.
That's very interesting because obviously that's the primary challenge in this market is even if you've got a low price to rent ratio markets, when you're looking at financing at 7.5%,
Hmm.
it's hard to make things cash flow. So by virtue of that forward commitment participation that you're doing and delivering the buyer a 5.5% rate, that's how you're getting that 8 or 9% first year return.
Correct.
It's great. And when you talk about 8 or 9%, or maybe you said 9 or 10%, is that an internal rate of return that takes into perspective appreciation and amortization, or is that just cash on cash?
No, that is cash on cash. Now, on our pro formas, we do lay out what the average appreciation looks like over 10, 20, 30 years. But that is just for you to have on the side. That's just additional information that is not factored in your overall rate of return. When we're looking at our first year rate of return, we're taking the 20% that you're going to put as the down payment, what the
Yeah.
annual return, what the annual rent is, property management fee, property taxes, and insurance. Now, since majority of our properties are not in any HOA, that's typically null and void. But if it did factor in, if there was a property that had a HOA, it would include that as well. So those are your basic fixed cost rate of return for that first year. And of course, as you know, buying your first year is going to look a little bit rougher because you've got closing costs and lending costs associated with that. So you really want to look beyond. It is not the get rich quick. You want to look at the 5 year, the 10 year, and the 15 year to see what that ideal return would be.
Yeah, absolutely. And I think what surprised me the most is being a landlord for 25 years, Lindsay, is how, if you would have asked me 25 years ago, hey Josh, what do you think this home appreciation will be in 25 years? I maybe could have guessed how much the home value went up. But you know what shocked me the most is how much rents have gone up. I
Yes.
tell this story all the time. We still own the first eightplex that my mom and I bought together 22 years ago. And when we bought that eightplex, the rents for 2 bedroom, 850 square foot, nice units right by the Capitol in downtown Salt Lake City, a great area. We were renting those units for between $275 and $315 a month. Well, today, those units rent for $16.95, and we charge for parking and we charge for storage. So we're like almost $1,800 when it's all in. And if you would have said, Josh, do you think you'll see a 600% increase on rents over 20 years? I never would have imagined that. But it's the power of inflation because inflation pushes up the rental income while your mortgage payment stays the same, or you probably have an opportunity sometime over the next 20 years where you refinance even to a lower rate. That's the power of long-term real estate investment, in my opinion.
Absolutely. I mean, it's inflation profiting, and that your
Right.
dollar is remain the same. It's locked in when you've locked in that fixed cost in your mortgage. And as rents continue to increase, now, yeah, other costs are going to continue to increase. But if there's one thing that history over the last 85 years has told us since we've been tracking it is that property values do not decline. I think total in the last 85 years, there were 6 years where it took a dip in the worst housing bubble that we've seen, but yet since have recovered and doubled and tripled in some particular markets, or it stayed at 0%. So if you look at the data, you're going to see that rents and home values constantly increase. Now, when we put appreciation on our pro formas too, we're not putting the appreciation that we saw in 2020 to 2022. That's unrealistic. That's your once in a lifetime, like maybe not once in a lifetime, but it's pretty rare. We're putting the average. So we're only basing that on a 2-3% appreciation, and the numbers are still phenomenal. We're undercutting what your appreciation or what your equity growth is probably going to look like, and it's still the numbers are tough to walk away from.
Yeah. Yeah. As I think about the headwinds or tailwinds for real estate, inflation is one of those tailwinds that I think practically guarantee a very good rate of return over a long enough time horizon. And I'll just share something that I've shared before on this podcast, but this is the US national debt clock. And we're approaching $37 trillion in debt in this country. And the fact is that our GDP, or our gross domestic product, which is correlated to our tax base, isn't growing as fast as our debt. And if you have growth that isn't keeping up with debt, there's really only one way to get out of this $37 trillion, which is through inflation. So the government, the Fed in orchestration, has to kind of continue to manufacture this manageable level, and sometimes it's unmanageable, as we've seen over the last couple of years, this manageable level of inflation, and that pushes your rents up. So if you are fearful of the US debt, if you're fearful of inflation, there's no better hedge, in my opinion, than watching your rents rise year after year as your mortgage payment stays the same and your mortgage balance goes down.
Absolutely. And even worst case scenario, and we've seen a lot of investors that have been hesitant, over the last couple of months, or even when times were a little tougher, or when rates started increasing, they're like, you know what, I think I'm just going to hang tight. I'm just going to hold on. Housing bubble. Let's say everything blows up. Housing is a basic need. So let's say that there is another '07, '08. Your property is still going to be able to rent. You're still going to be able to rent your property out and cash flow. Now, are you going to be able to rent it at a 3, 4, 5% year over year increase that you're seeing right now? Maybe not, but you're going to be able to maintain that level, even if you have to dip a 2% for a couple of years. You're going to continue to see it. And we know that because that's what history and the data shows us. So I think that understanding that is extremely powerful when analyzing any kind of real estate or investment deal.
Completely aligned with you. So you're not only a wickedly smart investor, but you're running a very successful business. So let's jump into the Spartan Invest success playbook here. I got a couple questions for you as an entrepreneur, as a business leader. So I believe Spartan Invest has landed on the Inc. 500 list multiple times. And I'm just curious, like, what have been the key inflection points, or perhaps some decisions that you can identify that have fueled your growth as a company?
I think the most important thing that has helped us be successful, and I could talk for hours about our team and our company culture, which have been vital to helping us get to where we are. But I think it's really primarily been our ability to pivot. Like I said early on, we saw the capability, the ability to scale, and generate more passive income for our company as well as our investors. So we completely changed business plans 2 years in. We said, you know what, we're just going to throw this in the trash and completely move away from it and do something completely different. And so I think seeing the different opportunities, seeing what's coming on the horizon, and being able to quickly pivot and make changes. I don't know how many times I sit around these round table with business leaders, whether it be in the state or whether they're at these regional conventions, and talk about, hey, you know what, well, this is the way we've always done it and it's always worked. And that mentality has really led to a lot of companies' demise. So I think seeing the challenges, seeing potential changes coming, and being able to adjust your business. And hey, we're creatures of habit. No one likes change. Even if you're used to it, even if I'm sitting up here and preaching to you, hey, you got to be able to change, I don't like it either. Because if you're talking about an operational change, there's a lot of different things that have to happen in order to be successful if you make that change. And there's going to be times where it messes up or things fall through the cracks because it is new. And you just have to move with it and move quickly. And I like offering the forward commitment. This was something that historically lenders were not offering large family sellers. It was only for new construction. In fact, I think we were one of the very first turnkey providers to start offering forward commitment. And it was at a time too where a lot of lenders now, they've adapted. Hey, you can buy it and extend it. The first forward commitment that we did, we bought down $2 million worth of loan amounts. And it was like, hey, there was no extension offered on that. So if we didn't use the $2 million, we lost the amount that we paid in that forward commitment. And that's just a very big risk to take as a business owner. However, seeing where interest rates were going, how they maintained at that higher level, and it was harder to move properties, we just knew that we had to take that leap. So I think that that's the biggest thing from an entrepreneurial standpoint, from a business owner standpoint, is just the ability to make changes and pivot.
I love it. Have you read the book Infinite Game by Simon Sinek?
Yeah, I love Simon Sinek. He is one of my favorite authors. The starts with why, Infinite Game. Yes, I love him. I've actually heard him speak in live one time.
He's an exceptional dude.
Yes.
And he calls that an existential flex, right? In the Infinite Game, he talks about one of the key success metrics of companies that survive, hundreds of years is they're open to an existential flex, and they have a just cause that is greater than just, making money or earnings
Yep.
or growth, but there's an impact that they're trying to create. And the moment that the way that you create that impact changes, you have to be able to flex into that existential flex and pivot, as you said. So I really think that's an important point that you bring up. Thanks for highlighting it.
Absolutely. I think he's playing the long game. I can't remember his like little slogan for it, but yes, playing the long game in that regard. Yes.
Yeah. Let me ask you another entrepreneurial based question. And I'm just curious, as your journey as founder and CEO, what would you identify as maybe one of the most challenging seasons or most challenging obstacles that you've had to overcome? And how did you mentally prepare yourself or get through those difficult challenges?
I I think this is pretty common. If anyone has ever run a business, started a business, you're going to come through those times where it's a lot harder. And over the last couple of years with interest rates going, you know, increasing, I would say that was the first time where we saw a struggle on our sales
Mhm.
side, and that we've been very blessed over the last 12, 15 years to that not necessarily being an issue. But you want to take that coupled with inventory challenges, that, homeowners are locked into a 2-3% interest rate, and they're
Yeah.
have no desire to sell. uh Man, there has been a lot of rougher times. But without using that same example, I'd probably have to go to 2019, our property management company. This is kind of a lengthy story, so I'll try to shorten it a little bit, but I think that it may be worth it. I don't know. We'll see. Let's see how the listeners think. But we
Let's
we
give it a try.
started the we'll try. We started the property management company wanting to do things differently. Property management, the industry in general, has moved very tech and very away from, hey, we're not going to have that one-on-one touch. And in
Mm.
doing a lot of research, that was investors' biggest complaint about their current property management company, was just the lack of communication to investor clients. So we were like, okay, we want to do that. We want to have our investor relations team that's going to be able to communicate, but then also to the tenants themselves. And there was the very big push for the electronic boxes, your self showings. That's
Yep.
been pretty common practice. And having those tenants, hey, go out to the property on their own, and really just have the platform walk them through the entire process. But when you dive into it, it's over 90% of homeowners still use real estate agents to purchase their first property. And they live in properties anywhere from 5 to 7 years on average. Our tenants reside in our properties on average anywhere from 3 to 4 years. So there's genuinely not that big of a difference. So why would we remove the agent completely? So we like, okay, this is good. This is going to be our approach. We're going to have that human one-on-one. So we were hiring leasing agents to help tenants walk them through that process. They have to be licensed real estate agents to show other owners properties. So we were having to pay for them to get licensed and pay for them, and it allowed us through our early years to have extremely high occupancy. And then we hit 2019 to where the our sales really took off from 18 to 19, and then our leasing could not keep up. We couldn't
Mm.
scale at that human side, and it hurt. And we got very behind. We had more properties on the rental market. We were paying investors rent because we just couldn't handle how quickly we had scaled on the sales side. And so that just required, I mean, that was, we spent a lot of money paying other people's rent
Yeah.
until we were able to pivot and merge the two processes together. So we started offering the ability to do self showings and to offer that to tenants wanting to find our properties, but then still having that agent on site. And so it really just required a whole table flip of the entire department, and in making a lot of moves. But now we have the ability to do both, and so we were able to get our occupancy back up to over 95%. That's our goal. That's where it has to stay in order to generate those returns that we discussed. And I think that was a really hard lesson to learn. I had a lot of very upset investors for the time being, as they rightfully should have been.
Thanks for sharing that. What a great story. I'll just ask you one more question, maybe about that time. But I always find it interesting how business owners and entrepreneurs overcome challenging times like that. And this question is more from like a mental mindset. Like, how do you get through, if you think through those main obstacles as an entrepreneur, how do you get through those difficult times from a mindset perspective? Because we all have to go home at the end of our workday, and we have to be mom, and we have to be dad, and we have to be a husband,
Mhm.
and we have to be a wife. So how do you make it through those challenging moments and still hold on to some semblance of balance and peace? If that word works for self-employed entrepreneurs, I'm not sure.
You know, that's tough. That is something that I struggle with. I am a wife and a mother. I have three children, and they take priority. My family takes priority over absolutely everything. So making sure that that's tough. Outside from a lot of wine, being able to manage that. But I will say that I try to, whether things are going great in the company or whether things are a little, struggling a little bit. I have certain, um, I don't boundaries, let's say,
Yeah,
that I'm not going to mess with. For instance, I am going to, I only try to travel and be away from my family once a month. That's
great.
it. So that's kind of my boundary. I have no problem working late. Sometimes it's just going to happen. But if I have to work late a few nights a week, I'm going to make sure I leave early and I'm picking the kids up from school that following day. I make sure that I'm either picking up or dropping off. Now, a lot of times, I mean, my husband's there to pick them up and take them to soccer and baseball and all of those things. But I'm making sure that I'm dropping them off, even though he can. I'm still making sure that I don't lose that with them. And so I think setting those very clear boundaries of no matter what's going on at work. And yeah, absolutely. There's times where it's like, hey, I didn't work late. I had to leave early to make sure that I got home and ate dinner with everyone, put the kids to bed, and then it was back to work. And then it was working until whatever time. And those are just the sacrifices that business owners have to make sometimes. But I think making sure that you set that clear boundary, so I never wanted to be 5, 10 years down the road looking back and saying, you know what, it wasn't that big of a fire at that time. Looking back, it was not that big of a deal. I wish I wouldn't have done this. So that's kind of how I deal and cope with it, but it is very challenging.
It's a great answer, Lindsay, and I appreciate you answering the kind of a personal question. But we talked about real estate being a long game. So is being an entrepreneur. So is being
Absolutely.
a business leader. Like, we can burn ourselves out and get to a destination we didn't intend to get to, i.e., you have no relationship with your family and kids, in the name of success. So I think that boundaries and deciding what's right for you and your family is extraordinarily important if you're going to have that long-term success and not burn yourself out.
Yeah,
I'm going to give you
absolutely.
I'm going to leave you with one more question that is less personal and a little easier to answer, perhaps. Back to the real estate. Let me just end with this question. What trends in 2025 are you seeing? Anything changing in the market that the markets that you're in, and maybe perhaps maybe something that you're excited about as it relates to a change in direction or trend in 2025?
I think that there's a few trends as there are every year, every 18 months, you're going to see a trend kind of trickle down. One thing that we are seeing is, like we talked about, the rental rates increasing. That has cooled. We are seeing that calm down where it was 7-8%
Yeah.
year over year. We're back now to a normal. Hey, we're going to look at like a 2 to 3% year over year increase. A trend has been the inventory issue. Now, not in all markets. And I think that this is also something to take into consideration when looking and evaluating, analyzing different deals in different markets is potential saturation. We've seen a lot of your hotter markets that just got flooded with new construction over the last 5 years. Now
Yeah.
they're taking a step back and saying, okay, now we've just shifted very quickly to a seller's, a buyer's market versus a seller's
Mhm.
market. And it happened very quickly with that, coupled with interest rates maintaining at a higher level. Well, we have not seen that in our markets, but I think overall that's a pretty normal,
Yeah.
that's a trend right now. And then we tend to see more interest in stable rental property investments when there is a lot of volatility in the stock market. We have the data to show that, and that when people start seeing their 401ks go down, take a dip, their
Yeah.
others, stock portfolios hurt or really just kind of move up and down, we see a lot of people gravitate more to stable rental properties, and in stable markets. So I think that that's going to continue to push. And we've been on a trend. The millennial generation started this trend of not necessarily always purchasing. I think inflation has exaggerated it a little
Hmm.
bit, but the
Yep.
millennials moving away and becoming more just the renter generation, where home ownership in general is on the decline, whether it be you grew up in the housing recession, or or inflation caused and you just simply can't afford it. So I think that's going to be a trend that we're going to continue to see, where we're going to have more and more demand for rentals just in general.
Yeah, couldn't agree more. Couldn't agree more. Well, this has been a fantastic podcast. Thanks for coming on with us, Lindsay. Where can people follow you? I know you have an exceptional podcast as well, but where can people connect with you?
Yeah, no, this has been fantastic. So if you want to hear more or learn more about Spartan Invest, please go to our website, spartaninvest.com. We have market reports. So if you want to learn more about the markets we're in, which is Tuscaloosa, Montgomery, Birmingham, Huntsville, Alabama, Chattanooga, North Georgia, Chattanooga, Tennessee, North Georgia, we have different market reports for those. We have an investor guide that breaks down everything that we do, all available on our website. And then we have our inventory. So if you want to just check out what we've got for sale, that is also on our website. You can fill out a form. We'll get you connected to one of our team members. Or if you want to learn more, I do have a podcast on the house with Spartan Invest that you can download and check out for any additional information.
And that podcast, I should mention, is very informative and educational to teach people how to be successful real estate investors, not an infomercial for Spartan Invest.
Absolutely. No. So the podcast is primarily focused on, we do have guests on that talk about various forms of investing, but the podcast is ad free, and we are deep diving into what an average pro forma looks like for us, what the eviction process looks like in the state of Alabama, what does how do we process maintenance work orders, those type things. It is geared towards answering those common FAQs that we see from investors when they're wanting to learn more and possibly invest.
I love it. All right, everybody, check out the podcast. Head over to Spartan Invest. Lindsay, thanks so much for your time. You've been a great guest. We hope to have you back in the future.
All right. Thank you so much for having me, Josh. This was great.